Hi, everybody. This is Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 65, titled The 20%, 10% Guidelines for Covered Call Writing and Put Selling. Same name, different circumstances. Now, those of you who have been following BCI for years know that position management is a critical aspect of successful option selling, whether it's for covered call writing or selling cash-secured puts. And we have an arsenal of exit strategies that will elevate our returns to the highest possible levels. One of those exit strategies we call the 20%, 10% guidelines. But these guidelines are quite different for covered call writing compared to put selling. And this podcast will explain in detail those differences. Let's start with the 20%, 10% guidelines for covered call writing. Now, when we sell a covered call, we are in two positions. We're long the stock, we own the stock, and we're short the call. We sold the covered call. Now, in order to avoid being in a very risky naked option position, if we're closing the trade, we must close the short call first. Otherwise, if we sell the stock first, we're then in a risky naked option position. For example, if we buy a stock for $30 and sell the $30 call, but then sell the stock, we still have a $30 short call in position, meaning we're obligated to sell shares at $30. Well, if we no longer own the shares, and I'm going to exaggerate this now, let's say the price goes to 100, we now have to buy the shares at 100 at market to then sell at 30 for our contract obligation. So we do not want to be in a risky naked option position. Therefore, the covered call must be closed by first closing the short call. That's buy to close. So what we do after we write a covered call is we immediately set up a buy to close limit order, a 20% in the first half of the contract and 10% in the second half of the contract. Let me explain. Let's say the original option that we sold was for $2. Now we immediately then set a buy to close limit order on 20% of $2 or 40 cents or less. So if the price of the stock declines, bringing down the value of that option to 40 cents or less, automatically our short call will be closed or bought back. When that happens, we're no longer in a contract obligation. We simply own the shares at the current market value. Now, with 2 weeks remaining until contract expiration, we changed that buy to close limit order from 40 cents to 20 cents, or 10% of the original option sale. Now, this is based on two factors. Number one, years of trial and error. I've tried percentages at various times over the years, back in the day when I first started teaching myself these strategies. And the 20%, 10% guidelines are the ones that work the best. But also, if we could do it from the perspective of the option Greeks, based on Theta, which is time value erosion. So for every calendar day that passes, the time value component of our options will decrease. Now, if we were to look at a graph of the time value erosion, or theta, for a near-the-money strike, we would see that at the beginning, the value declines, but very slowly. As we approach expiration, the final 2 weeks, the time value erodes exponentially. It literally falls off a cliff. Therefore, there is much less opportunity to generate time value premium in the latter part of a contract than in the earlier part of a contract. Therefore, I'm less willing to spend more money later than I am earlier. Therefore, the 20%, 10% guidelines, which allow us to retain between 80 and 90% of the original premium generated. Let's move on now to the 20%, 10% guidelines for selling cash-secured puts. Here, we're only in one position, the short put. Now, if the price of that stock declines, we do have a guideline for that. It's not the 20%, 10% guidelines. It's a 3% guideline where we close our short put if the price of the stock drops 3% or more below the strike price. But we also have the 20%, 10% guidelines if the price of the stock rises. Now, the relationship between share price and put value is inverse. Option value will fall if the share price accelerates. So if the option value declines to the point where we could retain 80% to 90% of the original time value early in the contract, we can close that short put and then use the cash that's freed up to start a new put position and therefore generate a second income stream, a second income stream in the same month with the same cash in the same contract period. This is analogous to the mid-contract unwind exit strategy for covered call writing. For those of you familiar with my exit strategies for covered call writing in my books and DVD programs. So let me give you a hypothetical example for the 20%, 10% guidelines for put selling. Let's assume we have a stock trading at $51 a share, and we sell the $50 out of the money put for $1.50. Now the broker will require us to secure that put with $48.50 as far as our cash investment to secure that put. That's represented by 5,100 shares at 50, minus the put premium of $150 for the 100 shares. So the broker would require us then to put $4,850 into our cash account to secure that put. Now, $150 initial return on a $48.50 investment represents a 3.1% 1 month initial time value return. Now, let's assume in the first half of the contract, the share price moves from 51 all the way up to 57. That will cause the value of the put to decline. If it declines to 30 cents or less, which represents 20% of the original $1.50, we automatically buy back that put. We close it. Now, the cash that we had to use to secure that put, the $5,000 less the put premium, is now freed up to then secure another put position, usually with a different underlying stock, which will then generate more cash for us than the original cost to close and represent a second income stream in the same contract month with the same cash investment. So two 20%, 10% guidelines, different reasons. Let's summarize now. The 20%, 10% guidelines apply both to covered call writing and selling cash secured puts. However, since the option premium is directly related to share price movement for covered call writing and inversely related for put selling, the strategy is used to mitigate losses for covered call writing, but to enhance gains for selling cash secured puts. Same name, different situations. So, ladies and gentlemen, before I close, I want you to go right to our website, www.thebluecollarinvestor.com, and take advantage of all the free resources we have there. We have covered call writing and put selling calculators in the free resources link on the top black bar of our web pages. We have free trading videos, blog articles, as well as our Beginner's Corner tutorials for both strategies that I alluded to in this podcast. Now, in the bluecollarinvestor.com/store site, we have books in various formats, ebooks, soft-covered books, a few are in hardcover editions on both covered call writing and selling cash secured puts. Check out also our online streaming DVD programs under our video lessons section, as well as our calculators and spreadsheets for all these strategies and covered call writing related strategies, as well as strategies that integrate both of these strategies, covered call writing and selling cash secured puts. We also have a trade planner and online mentoring programs as well. Check it out at www.thebluecollarinvestor.com/store. Folks, thank you so much for taking the time to listen to this BCI podcast, number 65, the 20%, 10% guidelines for covered call writing and put selling. Same name, but different circumstances. I hope you enjoyed this podcast, folks, and more importantly, hope it puts cash in your pocket. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.